All right, so ETFs and index funds. So what are they, right? So think of them as baskets of securities, which is, like I said, stocks, bonds, options. The trade in the exchange, right, in the New York Stock Exchange, just like stocks would do. You have some that are US based and some are international, right? So keep in mind diversification. Not only invest local, but also invest international because you have access to the whole world market. Here's some well-known ETFs. Invesco QQQ is one that I personally invest in, and it relies heavily on technology companies. Index fund is basically very similarly as well. The only difference, obviously, their ticker symbol is different, right? And there are some differences here, right? So how are they similar? Well, they're both bundled together. They're both baskets of individual, basically partial, stocks, right? So you're not investing in individual stocks, but you're investing sort of in a partial share, right? If that makes sense. They're low cost and they're passively managed, meaning that, like I said, this is super easy. Just invest and forget it, right? And typically they provide you with long-term results, which I'll show you here in the next slides. Now, the only difference really is that ETFs, you can buy them throughout the day, just like a stock. And the index fund, you have to buy basically at the end of day. So the end price, right? And typically ETFs have minimum investment, right? So an ETF might be $300, while a Vanguard, S&P 500 index fund might be a minimum of $3,000 to invest in, right? And the capital gains are a little bit more flexible, more efficient for ETFs than index funds, but both of them are really great options, right? And don't think too much about it, just do it, right? So when it comes to ETFs or index funds, these are based on sectors, right? So in the stock market in general, there's 11 sectors: energy, materials, industrial, healthcare, etc. Just like they're shown here. So let's think of something like consumer cyclical, right? Consumer cyclicals are companies that, like I said, it's not something that's it's not a staple, it's not a necessity, right? But it's things that include luxury items, airlines, furniture, cars, etc. And some of the companies that fall under consumer cyclicals are Home Depot, Lowe's, Boeing, or Nike, right? So like I said, just like how you did in the other category that we touched on individual stocks, this one is basically the same, but it's not categories, it's sectors. So do the same, rinse and repeat, right? So for this one, list out the sectors that you're interested in, right? And then find some ETFs that are associated with it. Like I said, always look at the historical trends. That way you can get an idea if this stock or this ETF or index fund is going to go up, right? Which most of them do. Like I said, most of them are already low cost. So the only thing you have to worry about is really discipline yourself to invest every month or so, right? So here's some sectors. Here's some ETFs, the equivalent of ETFs, right? And equivalent index fund, right? So maybe you want to show real quick. So let's say technology ETFs. And then you're gonna get a few list of ETFs, right? And you're gonna get an idea of where do they belong to, and also how much do they have, right? They're in their total volume, the total assets, etc. Right? So it's just gonna give you an idea of that research process that you have to do. All right. Again, always keep in mind, diversify. This is the example I gave you earlier, right? During the pandemic, Zoom, Grubhub, Uber Eats, that shot up way up, right? While a lot of other companies, including real estate sectors, were going down, right? So always keep that in mind. Diversify so that way you make money when the economy goes up and it goes down. All right. So like I said, here's an example of QQQ, which heavily relies on technology, right? So this one's made up almost of half of it is made up of technology. The rest of them is communication services. So think of internet service providers, right? Like AT&T, Comcast, Xfinity, that sort of thing. Consumer cyclicals, the ones that we saw as well, right? Financial services, etc. And when we see, these are the companies that this is made out of, right? This is mainly Microsoft, Amazon, Google, etc., or Apple. And that's what makes up this EQQ ETF. And very similarly, this is an index fund. This is Vanguard's BTSAX, which tracks the S&P 500. So basically it tracks the whole market, the top 500 companies in the stock exchange. And as you can see, this one's a lot more diversified, or it actually invests in a lot more sectors because it's tracking the whole market, right? The whole index. So in this one, this is lower, it's about 20, almost 25%, technology, industrials, energy, communications, etc. And these are the companies that make it up, right? So even though this one's not investing so much in technology, you can see that still a large portion of those are technology-based companies, right? And you could debate whether like Apple or Google are technology companies, because some might say that they're also financial companies, right? Because they also provide, credit cards and other things, right? And like I said, they're all made up of the sectors that we touched on earlier, right? So again, do your due diligence, see which one makes sense for you, but don't spend too much time on it. These are things that are supposed to be super easy and simple. So again, buy and hold long term. If we look at that ETFs for the last 5 years, you can see that it's gone quite a bit, right? Same thing for the overall stock market, right? So this is the S&P 500. As you can see, it's given pretty good returns, right? So think about it, right? Buy and hold is basically the key here. So imagine what's going to happen in the next 5, 10, 20 years, right? In 30 years, you could probably pay your house mortgage with this, right? Or you can pay for your kids' college. So keep that in mind. This stuff is very powerful, and all it requires from you is just to start investing, right?